Hi there. I'm Ben Strong. I'm Benjamin Strong. I said these wise words back in 1928, a year before the stock market crash. I'm probably one of the most important people you've never heard of. See, the problem now is we have to shape our policy as to avoid a calamitous break in the stock market. And as you see, Professor Mark has some of these impressively wise words here, and I think you can find them in this November 8th, 22 newsletter thing he's got here.
All right. Thank you, Mr. Strong. That's a nice introduction. And this is the StockMarketJobber.com weekly newsletter where we like to teach people about trading and we like to teach people about the history of Wall Street. And history is important when it comes to Wall Street because we'll see that things that have happened before. There's nothing really new under the sun, as they say, whoever they are. The names change, the people change, and we're going to see some parallels here between Mr. Strong and our current Mr. Powell, or some contrast, I should say, from 100 years ago. And the reason why this happens is because markets are a result of mass human behavior. And the companies might change, the people might change, but human nature doesn't change. Like, for example, we had a marijuana stock bubble, right? That blew up. Now we're seeing the cryptos blow up. Well, guess what? Back in the 1860s or 1870s, they had railroad stocks had a bubble. In the 1840s, it was canal stocks. So the players change, but the game remains the same, I guess. So one of the principles about markets is that there's some price levels that are more important than others. And this is important to know because it can help you with your order placement and knowing where you're going to have your order exits. In other words, it's going to help you figure out where to buy and sell. You don't want to guess. You want to let the market speak to you and tell you what to do. And how does the market speak to you and let you know what to do? Well, it tells you by the language it gives or expresses when it reaches an important support or resistance level. So when something gets to an important support or resistance level, it tends to do one of two things, either reverses or breaks. And both are typically followed with tradable moves. These support and resistance levels, the support level is a level where there's more interest in buying shares, or there's more buy orders than there is sell orders. I'm sorry, did I say that right? Support level is there's more buy orders than sell orders. A resistance level is the opposite. There's more selling than there is buying. So when markets are going lower, it's because sellers can't find enough buyers to buy all of their shares, so they have to offer their shares out at a discount in order to get buyers interested. When we get to a support level, things change. For the time being, at least, there's enough demand or buy orders to absorb all of the sell orders. So this is why markets stop going down when they reach support. Resistance levels, there's enough supply to fill all of the demand. So when markets are going higher, it's because the buyers can't find enough shares, so they have to bid a premium, and that forces an uptrend. But when we get to a resistance level, there's enough shares for sale that the buyers can buy all they need to. So these levels can stay important for months, if not years. This is called market memory. And one of the really fascinating things about markets is that levels that were resistance can become support, and levels that were support can become resistance. And this is due to market psychology, and we'll take a look at this in a minute. Here we have just an overview of the market. You could just refer to this as just to, I don't know, whatever, just a summary of where the important levels are. So the market kind of looks weak now, but let's remember we got some important inflation data coming up, and If it's a little bit, if it's better than estimated, meaning it's less than estimated, it could be bullish for the market, at least in the short term. I still think the market's going lower long term. Interest rates are moving higher. Oil has spiked. I mean, this could all turn around, but based on what we see with the inversion of the yield curve, it seems like there's been a lot of layoffs. I think this whole crypto sector is about to melt down. Longer run, whatever. That's my opinion, and I could be wrong. But one thing that's never wrong is the market. So we just want to see what the market is telling us and pick up their important signals. The market tells us how it's going to act by how it acts when it gets to important levels. Don't let the seeming simplicity of this throw you off here. As someone with my experience, I've been around the block a few times. I've worked for literally two of the best money managers in the history of the industry. And I don't mean I was just at their company. I literally worked directly for them. I was also the head of trading at 3 institutional money managers. So I've overseen the trading of various styles, various hedge funds, mutual funds. I was a market maker. But this right here shows you this principle of how resistance can become support and support can become resistance. Here we have resistance. What's a resistance level? There's a lot of sellers. Market goes lower, but what happens when the market goes higher? Well, a lot of these people who sell experience seller's remorse. They regret selling. They tell themselves, gee, I made a mistake. If these shares get back to the same price I sold them at, I'm going to buy them back. That'll make me feel better. It'll make me like erase the mistake in my head. So resistance can become support. If enough remorseful sellers are placing buy orders at the level that they sold at, these buy orders will create support. Now look at what we have here. We have the opposite. Support becomes resistance. This is people who bought, who, assuming they didn't sell their shares up here, experience buyer's remorse when the market goes lower. So a lot of these people say, I made a mistake, I want out, but I don't want to lose money. So here's what I'm going to do. If the shares get back to the same price that I bought them at, I'm going to sell them. So I'm going to place my sell order at the same level that I had my buy orders. And if there's enough of these sell orders being placed by remorseful buyers, what was support can become resistance. So this is why we need to pay attention to important levels. If the market moves higher, there's a good chance it hits resistance here again. And if it breaks out or breaks through, there's a good chance it finds support. So I'm going to bring Mr. Strong back on for a minute, and just so he can kind of let him tell his own story as to what he wanted to do and why he should be remembered as such an important person.
See, at the end of my life, I wrote the very existence of the Federal Reserve is a safeguard against anything like a calamity growing out of money rates. We have the power to deal with such an emergency instantly by flooding the street with money. It's too bad that they didn't listen to me. If they did, we probably wouldn't have had that Great Depression and all the pain and suffering that came with it. Imagine that, huh? Listening to somebody that knows what they're talking about.
All right. We appreciate that, and we respect you, sir. Thank you very much. Now, what we're going to do here is we are going to look at the technology sector. This is the biggest sector in the market. And it's been kind of volatile. People are asking, like, is this bear market rally or is the bear market over? Well, I think in order for us to really kind of say the bear market rally is over, this XLK ETF, and I should elaborate about that a little bit. The S&P is 11 sectors, and fortunately for us, State Street has these ETFs which track these sectors, and they're called spiders. I don't know where they came up with the name from, but anyway, the biggest sector of the market, which is about 26 or 27% of it, is technology. So this sector tracks that segment of the market. And I would be willing to say that until we get up above here, call it 131, 132. I just don't see us going into some kind of new bull market. I think we remain in this is, if we have any move higher, it's going to be kind of a bear market rally. Now, the next sector we look at is healthcare. And this is the second biggest sector in the market. It doesn't get the respect it deserves like tech does, because I guess healthcare is kind of boring to people. But look at this. This is our market memory. Resistance here, became resistance here, became resistance here. Support down here around 120, became support here. You don't need to be a market guru or some type of a genius to see that. Anyone can look at a chart and be like, oh wow, Mark's right. There really are some levels that are more important than others. So notice how this 127.50 level was resistance and resistance. If this thing moves lower, there's probably going to be some support around this level. And if it happens to move higher, we just got to watch to see if this breaks out. That'll give us a good sign as to where the broader markets could be going. And watching healthcare could be kind of interesting in a different way. A lot of times when people get worried or freak out about the markets, they sell things that are perceived to be less or more risky, and they put their money in things like healthcare or consumer staples, which are considered to be safer, because people are always going to need healthcare, and they're always going to need staples, which are things like food and medicine. So sometimes strong action in this sector of the market can tell us that the rest of the market looks weak. This is our financial sector. XLF is the symbol here. So I would say if we rally, I'd be looking for resistance around 35.80, former resistance level. So market memory, right? What was resistance can remain resistance. And here we see support becomes resistance. Resistance, if we come in lower, it could become support. So that's our financial sector. Next up, we are going to look at the consumer discretionary sector. Now this is the sector of things people need, or sorry, not need, things people want. Staples are things people need. So I made a mistake. But this again shows us an example of how some price levels are more important than others. The 155 level was resistance and it became support. It's just by knowing where these important levels are can help you so much with your trading. In understanding where those levels are, it's kind of like having a map to the market. So if you don't understand what to look for when you're looking at a chart, and if you're just going by what some quote unquote internet or chat room guru said, you might probably not going to have a good time. But if you start to learn, oh, what's support, what's resistance, what's converting back from support to resistance or vice versa, you get a good idea of which way the market's going to go here. So we had clear support around the 135 level, support here, and we're testing it now. So if this holds, we're probably going to get a decent move higher. And just because it trades it below this 135 level for 1 or 2 days doesn't really mean that the support is broken. These are big markets, and sometimes it takes a long time for things to work themselves out. So now, poor Mr. Strong, he had some bad luck, and I'm going to let him explain it to you, but let's just say that he could have been an icon had things worked out a little different for him. He was clearly ahead of, in terms of economic knowledge or knowledge of the market, a lot of people that were in power back then should have listened to him. So, Mr. Strong, why don't you please let us know what your thoughts are on this, and I'll be back in a minute.
Hey, I could have been an American icon too, but it didn't work out that way. I actually had a very sad life. My first wife, she committed suicide. See, remember, back in that day, they didn't have medication for depression. Had it been now, she could have taken a simple pill and it could have saved her life and saved her, sadly. You know, if you know anybody that has depression or suicidal, make sure that you help them get to the doctor, huh? My second wife, she left me in 1915, and then I caught that damn tuberculosis. Imagine tuberculosis after you lose two wives. I was sad, lonely, so I committed myself back to my work.
So sometimes people just get unlucky. There's an old saying on Wall Street, it's better to be lucky than to be smart. And of course, if it was now, a little bit of medication and maybe some could have prevented some of this stuff. So I just think I agree, if you know people that need mental help, please try to help them get it. All right, so here's our financial sector. And I'm trying to work this damn pen. Okay, got it here. Oh, I'm sorry. I meant industrial sector. Notice how we have resistance at 95. That's a nice round level. People like nice round levels. So my guess is if this moves higher, we hit resistance around 100. So I've seen retail traders do it. I've seen institutional traders do it. People just say, if it gets to this level, I'm going to buy or sell. People like nice round levels. Also down here, we see, look, little bottom. What was support became support. What was support back here became resistance here and became support here. So once you understand where these important levels are, then that's gonna help facilitate where you put your orders in, and it's going to stack the odds in your favor. Like anything on Wall Street, it's not a guarantee, but we're just about trying to put the odds in our favor. This is our communication services sector. This is where companies like Facebook and Google live, so to speak. Pretty interesting here that we're getting down to what are the COVID lows. So there could be some support around the $40 level. It's basically been in a free fall. But again, what we're doing is we're looking at a level that had been important in the past. And sometimes these levels can stay intact for months, even years. I've even seen them for decades. I know it's kind of hard to believe, but take a look at the chart of Bristol-Myers going back 30 years. Every time it gets to 74 or 75, it rolls over. Can I explain why? Probably not. I find it hard to believe that there are so many people that are just watching the charts that they do it, but I guess a lot of it is probably driven by computerized trading, which is based on historical patterns. That's my guess. This is an interesting chart here. This red line that we see up here is what's known as a Bollinger Band. And it's common software. It's on pretty much, or a common indicator, which is on pretty much every software, or every trading platform, I should say. Sorry, I'm fumbling over my words a little bit here. But this red line here is 2 standard deviations above the 20-day moving average. And this is important to know because when we exceed this threshold, there tends to be reversals, as you can see here, here, and here. Most of the algorithmic and the algorithms and a lot of the trading models are based on standard deviation, or based on statistics and probability theory. And standard deviation is a concept from statistics and probability theory. And what it says is 95% of all data, or in our case here, trading should be within 2 standard deviations of the mean. So when it exceeds this threshold, either to the upside or the downside, I didn't put the down one, the lower Bollinger Band here, which is 2 standard deviations below the 20-day moving average, just to make it easier to read. But when it gets above this, that gets the attention of these trading programs. They expect a reversion to the mean. And when they come in, their actions could push the price in the way they think it's going to go. For instance, if you're expecting a reversion to the mean, they'll come in as sellers and they could push the price down if we've exceeded the threshold to the upside. If we've exceeded the threshold to the downside, it could be the opposite. They enter the market as buyers and their actions could push the market higher. So with that, I'm going to introduce Mr. Strong again and let him tell us what he was concerned about and what he thought should have been done. And had it been done, it could have prevented the market crash in '29, and who knows, maybe it could have prevented the Great Depression. And the consequences are staggering. I mean, had there never been a Great Depression, maybe there never would have been an Adolf Hitler rising to power. I mean, this is something we could talk about probably literally for years. But with that being said, let me let Mr. Strong give you some of his wise words of wisdom.
But, sad home life, my career was extremely successful. After being an awesome and extremely wealthy investment banker, I became president of the Federal Reserve Bank of New York. How about that for a guy from Boston? Basically, I was by far the most powerful of the Fed banks. I became the de facto head of the Federal Reserve. And damn, I did a good job. So by 1927, I understood that the stock market was about to get out of control. So I raised the discount rate 3 times in 1928 up to 5%. So unlike the other experts, I was smart enough to understand that we needed this and it had to be done. But then I died of tuberculosis. That shit just kept creeping up on me. And then it seemed to forget about my policies and the Fed just let it ride.
Yeah, things could have been very different, sir. But sometimes smart people get ignored and people that are dumb get listened to. This is our energy sector here. We peaked back here in 92.50. The ETF is XLE. And a lot of times we run into resistance at former resistance levels. So I would not be surprised to see some profit taking here. Maybe a little bit of a move lower. And where would I be looking for support? Well, around this 85 level because it was resistance. Well, it's actually 84.50, but we don't want to get that precise. So this looks like there's a chance it could at least stall out before moving higher. But my guess is it comes in because the action in oil has been a little bit, looks a little bit bearish. So at StockDobber.com, if you're interested in following these sectors, and you should be if you want to be a successful trader, hopefully you'll subscribe to our sector analysis page. And you can get more in depth, and we talk about different sectors every day. So if you really want to learn how to trade short term, I think it's going to be well worth your effort and money. This is our utility sector. Once again, we see our principles here. What was support became resistance. It's resistance here. Been trading kind of sideways. So we're going to look for either a break lower out of the range or a break higher out of the range. This is a little rectangle pattern. All it is a trading range. But on the top of the range, obviously, there's resistance, and on the bottom, there's support. So like I discussed before, if this breaks one way or the other, it's going to show us, well, if it breaks higher, it'll tell us that a lot of those sellers are out of the way. And if it breaks lower, it'll tell us that the buyers are out of the way. So if the buyers are out of the way, the sellers are going to need to offer shares at a discount. I'm sorry, if the buyers are out of the way, the sellers are going to need to offer shares at a discount. If the sellers are out of the way, the buyers are going to need to bid premiums. So that's what forces trends. If there's not enough supply to satiate or satisfy all the demand, markets trend higher. If there's not enough demand to absorb all of the supply or selling, markets trend lower. Here we have our basic materials sector. This is home of our quote unquote boring stocks. things like paper companies, chemical companies, but there still could be money to be made here. Just because it's boring, making money is not boring, but look at this, support becomes resistance. Eventually, you're going to get to the point where you're just going to be able to look at a chart and see this staring you right in the face. Support becomes support, support became resistance, resistance becomes support. This here could be what we call a breakaway gap. After a move lower, when you get a big, powerful move like this, where it just gaps up, it means the buyers are so aggressive that no one even bothered to buy it in here. They just waited for it to get to a higher level. So those are usually coming off of a bottom or off of a support level. A breakaway gap just shows a lot of enthusiasm, and there tends to be follow through. This real estate sector here is actually a really good example of market memory, right? Now, this would be kind of hard to believe if you didn't see it on the actual chart, but for some reason, recently, XLRE, the real estate ETF, found support at the exact same level that it did way back in 2020. So this is market memory. Support years later becomes support. And we can see here resistance around the 3880 level was resistance. It became support. And if we move higher, there's a good chance that it's going to be resistance again. So logical trade, buy at support, sell it, buy former support, sell it former resistance. Doesn't need to be that complicated. Here are our 5-year yield, or sorry, 10-year yields. And as long as these stay higher, this is going to be bearish. But if these things get back below 4, that could give us a little bit of upside in the market. I don't know if it's going to last. All right, well, I want to bring in Mr. Strong for some of his final remarks, and I thank you for joining us. But I'll be back when he's done, just for some final comments.
And here's a real kick in the balls, right? When I died in 1928, they didn't even pick anybody to replace me. Can you believe that? Idiots. They could have saved a country if they had just thought about what I was trying to tell them. But they did nothing. The Fed was rudderless. There was a major mistake. The market crash was one of the things that led to the Great Depression. The other two things that led there was the Smoot-Hawley Tariff and Tax Act. This guy Smoot, man, I tell you, he was a character. This tariff that was meant to protect the American interest, but it was also led other countries to enact their own tariffs. The result was a collapse in the world trade. There was also the dumbass idea of raising the balance of the budget. See, back then, a balanced budget was considered a great thing, and in general, it is, but not during an economic slowdown. See, these three major mistakes by the government prepared for the Great Depression. Had I lived a little longer, history would have been different, and we could have saved a lot of people, and America would have been in a lot better place.
All right, Mr. Strong, thank you for joining us this week. I'm glad that you had a chance to express yourself. I'm sure you've been waiting for a long time because unfortunately you're a pretty forgotten person, but if you all just review this, it'll just teach you a little bit about understanding trends, levels, and momentum. Market sell-offs tend to pause or halt when they drop to support, rally support, or halt when they reach resistance. So I'm not going to go through all these points, but it's just something you should study if you want to learn how to trade. And last but not least, here is me. This is my biography, or some bullet points on my biography, I guess I should say. And I was fortunate enough that I traded for Mario Gabelli and Steve Cohen, who are two of the greatest money managers in history. So it's almost like you take piano lessons from Mozart and Beethoven. I got my MBA at NYU, blah, blah, blah. I hold a CMT, blah, blah, blah. I was a classical guitar player for a while. When I got out of college, I was a professional, but within about 6 months, I realized how hard it is to make a living being a musician. So I decided to move on to more practical way to make a living. And I just think that this here is just sarcasm, right? Sarcasm. Because since I've started talking to the retail world, I realize how many misconceptions there are about market makers and hedge funds, and they're out to take advantage of the little guy. And I can assure you that that is not the case. So if you want to find out why, or why not, I should say, you can become a member of Stock Market Jobber. And thank you very much. And I guess I will see you all next week. And thanks again, Mr. Strong.